question for Mr. Gross, if you would.
I do. Hi, Bill. I agree with you on the U.S. economy concerns. How about in Asia? That people have been worried about China hitting a hard landing. I'm thinking that China can control its situation better than people think through its control of the banking system, and we may see growth. We saw this morning General Motors doing more sales in China. What do you think of that?
Yeah, I think they can. I mean, China's been the story, has it not, in terms of the developing countries? It's really become the engine of global growth, and we look to China as well to be the engine, although, not the little engine that could, certainly a bigger engine than that, but not to replace the United States over the past several decades. And so, global growth will be positive. Emerging nations will be the thrust of that growth, and the developed nations, of course, with their debt overload, will suffer.
Well,
I'll try to put Bill on the spot. Would you still be buying U.S. Treasuries at these low yields today?
Oh, that's putting him on the spot. Very good, David. What are you doing this morning, Bill?
Well, nothing yet, talking to you. Here's the conundrum. It's a new conundrum, I suppose, in terms of interest rates as opposed to the old one. But the new one is simply with the 10-year Treasury at less than 3%, that represents something almost historically low, but certainly much better than the 0.25% that you can make with money markets. If inflation continues down, and if nominal GNP, and this is the key, I think, if nominal GNP in the United States is around 3%, which is our new normal forecast, then a 10-year Treasury is decently valued. It's not cheap, but it's decently valued, and certainly a better alternative to money markets.
And look in here, if I want to put this up for the camera, this is the brand new Bloomberg Markets magazine. I don't know if you camera guys can get that there. Handsome Bill Gross on the cover with the dreaded stocks word. Bill, it's been a tough week for equities here. What would you do in the I can't believe I'm asking Bill Gross's question. What would you do in the equity market when you see a jobs report that we just saw?
Well, the equity market is obviously getting cheaper. The bond market is getting richer, and so that's a plus for equities. But the stock market is obviously connected to the new normal to the extent that the global economy and the U.S. economy are slower growing, and profits are slower growing, and the attraction of equities relative to fixed diminishes to some extent. We still think over a longer-term basis, Tom, that when appropriately valued, in other words, from a starting point, that prices in stocks at an appropriate level, that stocks will do better than bonds. They're risk assets, and they're priced appropriately for that. But in this type of environment, stocks and bonds, and I think this is the important thing from our standpoint, stocks and bonds are in the low single-digit return category.
Bill, are you concerned about a jump condition on the yield curve? We've come in so much 2-year, 10-year, and really any space on the U.S. yield curve. Is it a gradual path to higher yields, or do you worry about some shock condition that could really jump yields?
Well, there are two tails, as you mentioned with your question, Tom. The one tail being the inflationary tail, and the dreaded enemy, so to speak, of the long bond, and the other, of course, being the deflationary tail, with long bonds having the potential to move lower, a la the Japanese market. We think those are fat tails. Those are, decently gray swans as opposed to black swans, and because of that, we're sort of in between in terms of what could happen. We're monitoring. I think all investors should monitor the situation in terms of global aggregate demand for hints of either deflation and debt destruction or inflation down the road.